Hello everyone, and thank you for joining us this evening. We know that markets have been volatile of late, and we're looking forward to answering a number of your questions. By way of introductions, my name is Robin Conway. I'm the General Manager of Managed Funds. We have Sam Dickie, one of our Senior Portfolio Managers. We have Louise O'Brien, one of our Senior Wealth Advisors, and we have Ashley Gardyne, our Chief Investment Officer. Welcome, team.
Thanks.
Now, for those of you who are dialing in tonight, we've received well over 500 questions. So we've captured the themes that we're going to go through this evening, and we'll also answer some questions live when we get the opportunity later. Now, as always, we have a disclaimer. All the information that we talk about tonight is generic in nature and should not be considered as financial advice. If you do want advice tailored to your circumstances, then we would encourage you to speak with an advisor. Right, Ash, this first question is for you. Why did markets fall so rapidly on the announcements of tariffs on Trump's so-called Liberation Day? How has that flowed through to managed funds and KiwiSaver balances?
Yeah, so there's been talk of tariffs ever since the US election outcome, right? So the question really becomes, why did markets fall so drastically? And it was essentially because of the extent of them. They ended up being quite a lot broader, and in some cases quite a lot bigger than most people expected. So people were probably thinking 10% tariffs potentially, but we saw tariffs of 34% on China and 20% on Europe, and then even parts of the world like Vietnam saw tariffs of 46%. So people saw that and they said, well, what does that mean for economic growth? What does it mean for inflation? And people started to think, well, that could be bad economically, and markets essentially sold off 10% pretty quickly. And it was a global thing. It wasn't just the US. It was the globe, US, Europe, Australia, and that obviously had an impact on KiwiSaver balances as well.
Yeah. And now, Ash, again, to you, people listening in would have also seen that there's been a partial rebound in the last few days. What's driven that movement?
Yeah, so essentially the rebound was driven by a rollback of the exact same thing. So Trump came out pretty quickly, about a week later, and said, actually, we'll have a 90-day pause. And that was met with a lot of relief. Markets jumped actually 9.5% in one day, which is a really big move for the S&P 500 in a short period of time. And essentially, market was getting really quite concerned before that. It was down about 18% in total for the year. And the concern was that it was sort of the uncapped nature of tariffs. So there was a risk that if countries retaliated, that the tariff levels could have actually gone even higher. But by essentially opening up the route to negotiations and saying that there were 70 countries already keen to start negotiations, it put a cap on the tariff level, essentially at the rates that were announced, and have given everyone room to negotiate downwards towards that 10% level that everyone's been talking about. So it just provided a little bit more clarity. And I think the other thing, it provided some assurance that Trump was actually watching markets as well. He wasn't just going to go ahead at all costs. And if markets did react in a negative way, which they did, he might pull back a little bit. So that provided a lot of comfort as well.
Yeah, great. Thank you. Now, Sam, moving to you, ignoring the headlines and the market movements for a minute, based on what we've seen so far, what could the actual economic impact of these tariffs be?
It does change by the day, but I think if you sort of construct a reasonable base case, so 10% baseline tariffs on most of the globe. Yes. China will be higher. There'll be some retaliatory tariffs against the US by China. And I think uncertainty will persist for a while. So if that's your baseline, I think US GDP could fall by maybe a couple of percent, most economists think. So last year was 3% GDP growth. It could go as low as sort of 0.5% or maybe 1% this year. Yeah. Chinese growth was going to be about 4.5% GDP growth, and that could fall to 3%. And Europe would be less impacted. So those are the major blocks. And then if you think about inflation, which is the other sort of key piece of the puzzle, US will import inflation. So that was hovering around 2.5%. Remember, the Fed's target for inflation is 2%. It was nicely drifting that way. That will probably jump to about 3.5% in the second half of the year. So that's a little bit of an uncomfortable mix, as Ash said, for markets, that sort of slower growth and higher inflation. But really important to note, and Ash alluded to this, is if things do get worse, 2 or 3 things can happen. Firstly, we should expect supportive monetary policy from the Bank of China, the ECB, and even the Fed. And the point Ash made was really important, is we found Trump's pain threshold. And that pain threshold was not equity markets falling, as maybe the equity market hoped. It was credit spreads widening and really the price of money going up, so bond rates going up, the price of credit going up. and he rolled back those things very, very quickly. So that was encouraging to see, as Ash said.
Yeah, great. Thank you, Sam. Now, this next question is for you, Louise, and it's one of the questions that we've received the most, which is essentially, what should investors do in response? Should they be moving to a more conservative option?
It is the most common question, and it's based on the way we feel. When you feel pain, you want it to stop and you want to take action and do something about it. And we have seen investors switch from, let's say, a growth strategy to a more conservative one just over the last week.
Yes.
What they're doing, though, when you're moving from a growth strategy where you've got about 80% of your money invested in shares to, let's say, a conservative strategy, which is maybe 20 to 30% of your money in shares, you're taking 50% of your balance, moving it out of the shares that cause the pain, but they are the very things that are going to bring you out of the hole that you've probably already fallen into, which has triggered your action. So what you're doing really is you're cutting the ropes to the things that will pull you out of the hole.
Yeah.
So generally, we don't recommend that. Trying to time things by sitting on the sidelines and coming back. Often the case is it's fallen, you're making real a paper loss by selling those shares, and then by the time you're feeling comfortable enough to come back in, you've missed a big recovery. I mean, already we saw just last week a move of 10% in a day, and you can't afford to be out and miss that day, and that's what can happen. Having said that, I think the other piece to moving to a more conservative strategy, there are times when it is suitable, and we've got to take this opportunity where volatility has raised its ugly head. When people want to revisit their strategy, they may just not be in the right one. And so if, for example, they need some of their money out short term to spend it, that's earmarked for something that needs to be spent on in the short term, or they're just not coping. If they're feeling sick every time they hear the business news on the radio, or just not sleeping at night, that's not good for anybody. So our goal is to have people in a strategy that they can stick with. So if it does go, even if it does go down from here, they're resolute about, I can stick with it, rather than to then panic later on.
Yes, absolutely. And I guess just to get a little bit more specific on that, we have had one client asking that they've got 4 years until retirement, and should they be moving from a balanced to a conservative fund? So much like what you were talking to, but what should they do in a circumstance like that?
It depends so much on what retirement means. We all know it means money stops coming in and it starts going out. So that all of a sudden changes your mindset about how you treat your savings. So I do understand. And once again, it's a good time to revisit things. If your retirement means that finally you get to stop work and do the things you dreamed of and spend all your KiwiSaver balance on a motorhome or travelling in Europe for the next 6 months, and you're going to do that within the next year or two, then yes, it does make sense to move your money into something more conservative, because you're going to spend it and you want to protect it. But generally what we observe is, as you have saved your money gradually over the years, that's how you spend your money gradually over the years. And most people will be in retirement for at least 20 years, 20 to 30 years. And if that money has to last you for that duration, it's a long time to sit in a conservative strategy.
Yes, absolutely. That decumulation is really important.
Yeah.
Thank you, Louise. Next, moving to you, Sam. How has New Zealand been impacted by these tariffs?
New Zealand and Australia actually have been relatively better off. So they got hit by that sort of baseline or minimum 10% tariff.
Yes.
And we're in a 90-day pause, as we talked about at the moment. But if you think about that relative positioning, if that pause comes off and those reciprocal higher tariffs go back on other countries around the world, New Zealand and Australia are relatively better off. So if you think about that same framework I applied to sort of the globe, those big trading blocks, US, China and Europe, I think economists think the hit to New Zealand GDP is only going to be about half a percentage point, so 0.5%, so pretty mild in the scheme of things. Then you sort of drill down a bit further, what are the sectors that might be hit the most? So the meat industry, and beef in particular, are big exporters to the US. I think about 30% of our exported meat goes to the US. Only 5% of dairy, so China's our big sort of dairy trading partner, and 35% of our wine exports go to the US. So that was interesting. In terms of how the equity market could work, actually inflation, I'll touch on inflation as well, because that's growth and which sectors are impacted. while inflation will go up probably in the US as they import inflation via these tariffs, the opposite could be true for New Zealand. So first and foremost, we've seen the petrol price at the pumps, which is great for everyone. Some welcome respite for consumers has gone down. So that's been driven by the fact that the market is pricing a bit of a demand shock to global growth. So therefore that impacts oil demand. The other thing is there's going to be a lot of goods potentially wanting to sidestep the US tariffs and looking for a home around the world. So you might see a glut of Chinese or Asian or even European goods finding their way into New Zealand, which would be deflationary. Yes. And the final point I'll make is on the equity market here. So it is a pretty defensive equity market. So we've got a lot of gin tailors and utilities and property companies which are fairly defensive. So that's good. And the final thing is that the direct impact on portfolio companies is fairly limited. So the biggest stock in the market, Fisher & Paykel Healthcare, one of the biggest stocks in our New Zealand portfolio, they have 2 manufacturing bases in New Zealand and Mexico. Importantly, in Mexico goods that Fisher & Paykel Healthcare exports into the US are protected via the US, Canada, Mexico free trade agreement. So they attract 0% tariff. So that's really, really important. So the only impact really will be goods we export from our New Zealand manufacturing base to the US, and we think that will hit profits by about 5%. Someone like Delegates, who is a big wine exporter to the US, could have an unmitigated impact on its profit of about 13%. But what's really important for those 2 companies is they have some pricing power, so they could pass on that cost increase that comes as a result of the tariffs to their consumers. So in general, I think New Zealand's going to come through this pretty well.
Yeah, great. Thank you. Now, Ash, moving to you, another question that we've had a few times coming through is how risky is the US as an investment destination? Are we at the end of this decade or 2 we've seen of US exceptionalism?
Yeah, it's been a really hot topic at the moment, and part of the reason for the hot topic is the last 15 or 20 years the US has just performed phenomenally. And I think over 15 years, the US market's outperformed Europe by something like 250%, which is it's been the place to be. But partly because of the rapid rise in markets in the US, valuations got expensive. And if you combine that with the political strife we've got there at the moment, the fact they're pulling back on government spending, you could see some reasons in the tariff turmoil, you could see some reasons why economic growth slows there, just at the same time that Europe's starting to talk about spending more money on some fiscal spending, some infrastructure spending, defence spending. So there's a bit of a debate out there as to whether or not Europe could overtake for a period of time US in terms of performance. So that's something for investors to think about. But you also have to remember the strong performance of the US over the last decade or so hasn't been because of anything governments have done. It's been because they're amazing companies and the innovation in the industry. So, companies like Amazon or Nvidia or Microsoft, phenomenal businesses, and they're not just US businesses, they're global businesses. And we don't really see too much getting in the way of the long-term growth of those businesses. So it's never black and white. And we always say you don't want to try and pick, what market to be in and just pick one or two. There are great businesses all over the world. So we're always, the investment team spending time looking at businesses in different markets and trying to make sure you have a diversified portfolio and pick the best from each market.
Yeah, absolutely. Thank you. Now, Louise, moving to you, we asked a question previously around the right strategy and fund for someone close to retirement. We're also getting quite a few questions for people who are looking at using KiwiSaver to save for their first home deposit. Now, obviously, if they're accessing that, what should they be doing in response to all of the movement and volatility that's going on?
I don't know where their starting point is, but what I would say is if you are planning on buying a house in the next couple of years, you don't want to have your KiwiSaver balance exposed to share market risk. That's a real example of the impact of share market falls will have a direct impact on your lifestyle and your ability. I mean, every dollar counts when you're trying to save for a deposit and you're trying to work out what you can afford. The last thing you need is a share market correction wiping off a decent chunk of your balance. So I would recommend always be in a conservative fund and preservation fund and take that piece of uncertainty out of your life. It's hard enough finding a house to buy. You don't need that stress on top.
Yeah, absolutely. And sticking with you, Louise, another common question that we're getting is for regular savers. So should they be continuing to add more to their investments or waiting until the markets settle?
You see, this is the example of the small or the group of investors who should enjoy what we're going through now. Because when you are making regular contributions through volatile times, you're buying units at depressed prices. And sooner or later, when the recovery comes, you've turbo boosted your future returns, and they will inevitably rise again. So if anything, double your contributions, because that's the one type of investor in this environment where they should be really making hay while the sun shines.
Yeah, absolutely. Now, Sam, moving to you, how does this compare what's been going on, obviously, with the tariffs to prior crises, and how long do we think that this might take to recover?
Sort of smiling the way Louise smiled before, because it's a great question, but there's three types of bear markets, and we've got to remember last Tuesday we were in a bear market. Remember, the definition of a bear market is a fall from peak of 20%. So we sort of have US mid caps in a bear market. We have the NASDAQ and global IT stocks in a bear market as at last Tuesday. And as Ash said, what a difference 6 hours makes.
That's right.
But there's three types of bear markets. So there's an event-driven bear market, and I'll explain what these mean in a minute. There's a cyclical bear market and a structural bear market. So an event-driven bear market, which is the one we think we're in, was caused by an event, which happens to be Liberation Day.
Yes.
Yeah, a cyclical bear market is one that sort of morphs into a deeper recession, is driven by sort of the economic cycle or the business cycle. And the third one, a structural bear market, is where we have structural imbalances and financial bubbles. So you might think of the Great Depression or the global financial crisis. To be clear, we think we're in a event-driven bear market, and they're the most benign form. And the equity market can be only weak for as short as 6 or 8 months in those periods. And the drawdown on average, this is going back to the 1800s, by the way, is about 27%. So if you think about some of those indices as of Tuesday last week, they were down as much as sort of 23, 24, 25%. So we were there or thereabouts for an event-driven bear market in terms of the magnitude. Now, true to form, like any bear market, if that event reverses course, like COVID, for example, which was a bear market, an event-driven bear market, you should expect equities to reverse. So Trump walked back because we reached his pain point, and equities rebounded, as Ash said. So that's the framework at the moment. Important to note, though, Robin, an event-driven bear market could morph into a cyclical bear market if there's a significant rise in retaliatory tariffs or uncertainty persists for a much longer period of time. So that's something we'd keep an eye on.
Yeah, absolutely. Now, Ash, moving over to you, what are we doing in our portfolios in response to this? Are we seeing opportunities as a result of what's been going on, and what specifically are we doing? I will jump to both of you. So Sam, perhaps on international stocks, and then Ash, if you'd like to talk to KiwiSaver.
Yep, okay.
I'll kick it off, Ash. So I think the first thing we do, and this reminds me of COVID and to a lesser extent the global financial crisis, is the first thing to do is make sure you've got a handle on the direct impact on your portfolio companies. So it is fluid. Things do change in sort of 6-hour blocks, as we all know. So you want a framework rather than be too specific around this. So the framework we're employing is sort of 3 or 4 buckets. So the first bucket being, are your companies directly impacted, first round impact by the tariffs of importing your goods into the US? So the worst case scenario would be a t-shirt manufacturer that sells all of its t-shirts in the US but imports them all from China, for example. The second bucket is, are your companies directly impacted by retaliatory tariffs that other countries will put on the US? So kind of the worst case scenario would be a US auto manufacturer that exports a lot of product to China, for example. And the third bucket, and this is really critical because we think most companies around the world are a little bit impacted by tariffs, is how are you relatively off relative to your sort of key competitors? So when we think about that, that's kind of right in our wheelhouse, our sort of 3-pillar wheelhouse of we like to look for companies with wide and widening moats, and they typically have more pricing power, so they can pass on to their consumers or their customers the cost impost from these tariffs. The second thing is, do you have some sort of scale advantage over your competitors so that you can withstand the shock better? So that's the framework, and bearing that in mind and sort of thinking back to last Tuesday when things were getting reasonably well sold down, and we saw some of the fear indices out there, the most elevated they've been in 20 years. We were kind of deploying capital in 3 ways. The first way was companies that have wide moats and good pricing power, like I said, but are partially impacted by tariffs, and we've been looking for an opportunity to buy them. We took that opportunity. So that's companies like Intuitive Surgical, for example, Gartner or even Meta. The second bucket of companies we'd started to deploy some capital into last Tuesday was ultra high quality companies that have been expensive for quite a long period of time, but they got caught up in that indiscriminate selling on Tuesday. So companies like Costco, for example, ultra high quality. And the third bucket is sort of going at the heart of the problem. So taking some profits in our defensives that have done really well for us during this period, like United Healthcare and Boston Scientific, and deploying that capital into companies that aren't directly impacted but are high quality companies like a KKR or an Amazon, for example.
Okay, great. Thank you.
Yeah, and perhaps just to sort of lifting up a level, I guess the investment team actually becomes more productive as an investment team member during periods of uncertainty because there's just a lot more opportunities. So Sam's talked through sort of things they're looking through at the moment, but just the sheer dispersion of outcomes across different asset classes and companies. You'll have some companies whose share prices have barely fallen at all and others that are down 25, 30%. Some asset classes like fixed income are really holding up while shares are falling. And those dispersions allow you to change portfolios around, essentially, sell some of the things that have been more defensive perhaps and put money into the portfolios that have been under a bit more pressure. So the team's certainly been exceptionally busy looking for ideas. There's been more trading volume and repositioning of portfolios. And another good example of that would be in our fixed income portfolios, which make up quite a big part of some of our KiwiSaver funds. In those portfolios, you have government bonds, which are usually really safe, and corporate bonds. And we've had a lot of government bonds in the last couple of years because you haven't got much extra reward for lending to companies over governments. But that changes in a crisis like this, and we've seen that the extra spread you get from lending to a company over a government really expand in the last couple of weeks. So we've been really moving fixed income investments from government bonds to corporate. So that's one way to take advantage of it. But also just in our broad KiwiSaver portfolios as well, just through things like rebalancing. Whenever markets are falling, equity markets and bonds are holding up, we'll be selling bonds at the margin and buying shares at better prices. And so we're essentially trying to rebalance and taking advantage of the market turbulence on behalf of clients so they don't have to worry about doing that rebalancing themselves.
Yeah, that's great to hear. Thank you. Now, Louise, moving to you. One question we've got a few times is whether it would be safer to switch to investment property to avoid the volatility that we're experiencing in share markets.
I don't think trying to avoid volatility is a good reason to buy property. When you sell units in a pie fund, you're walking away from diversification where your money is spread across all different asset classes, different companies, different sectors. And you're also foregoing the liquidity that managed funds offer you. Not in KiwiSaver, you're locked in till 65 with that. But if you're talking about a managed fund which would normally be accessible, when you buy a property, you're foregoing the diversification and liquidity and taking on ownership risks. So those are the sorts of things like disaster, impact of natural disasters, fire, tenants, debt potentially. That's not for everybody. I mean, it has a place, property, term deposits, property, managed funds, they all have a place in a wealth plan. But if you're buying a property because you don't like seeing your portfolio go up and down, I think you'll be biting off a bit more than you chew if you think I wouldn't call property a safe investment necessarily.
Yeah, absolutely.
Because of those risks.
Yeah, thank you. I'm going to jump to a couple of other questions for each of you. So, Sam, we'll stick with you. Are there any unintended effects on tariffs for New Zealand, like lower prices or a more competitive export sector?
Yeah, I think that that point on the sort of bifurcated nature of the inflationary impulse. What I mean by that is inflation will go up in the US as they raise tariffs on imported goods, whereby we could have some of those goods searching for a home outside of the US, so they're not captured by that higher tariff, and there could be a bit of glut of goods sort of flowing into New Zealand. So you could have a bit of a disinflationary force. So I do think that's a unintended consequence or a cross current, and we've already seen that with the price of petrol. Welcome respite. In terms of a more competitive export sector, yeah, I do think New Zealand is relatively better off. So if you think about the sort of 20% type tariffs on Europe versus the 10% baseline tariffs on New Zealand, you think about wine flowing out of Europe versus wine flowing out of New Zealand into the US. That's a relative advantage. And in terms of how the currency moves, I think that's a bit of a wild card, but if we for some reason saw a very strong US dollar on the back of this and a weak Kiwi dollar, that's also good for our exporters.
Yeah, great, thank you. Final one for you, Ash. How might all of this develop from here? What news and developments are we watching for in the investment team?
It's obviously a really fluid situation, right? So every morning you wake up, there's about 3 different announcements all going in different directions. And it's really hard to get a gauge on what's happening next. But what everyone's really looking for, and maybe it's over this 90 days, maybe it's shorter, maybe it's longer, I don't know. We're really trying to get to the heart of the question is what are the final settings going to be, and what's the long-term impact going to be on companies and industries? So what are the fundamental impacts? So everyone's trying to grapple with that at the moment, and I think there's still a lot more information that we need to ultimately see that. I think also there'll be some real ups and downs, so we should expect more volatility. There'll be headlines, it'll be played through the media, right? So there'll be debates between Europe and the US through the media, US, China, and at times that will cause some more market volatility as well. But it's important also to keep that in context, and I think we have over the last decade had quite a lot of different events that have impacted markets, whether it was COVID, the inflationary spike in 2022. We had another trade war back in 2018, wasn't quite the same as this one, but it still was quite a big event. The war in Ukraine, there's been all these events that have had short-term impacts on markets. And I think COVID's quite an interesting one because it also impacted supply chains the same way tariffs did. And it was in some ways more extreme because borders were actually shut and inflation on some goods was really high and you couldn't move in between different markets. But ultimately, the world adjusts, economies adjust. There may be some new rules around trade, but businesses will adjust to that. And ultimately, you want to sort of zoom out and take a long-term view, because if you do that, I think we've still got some great businesses globally that will keep growing, keep paying dividends, and the share market still should deliver great returns for investors.
Yeah, a great way to wrap up. Thank you, Ash, and thank you, Sam and Louise, also for your insights. We hope that's answered all of your questions. For anyone who does want additional information, please feel free to have a look on our website. We've got plenty of information online. We also have people who are able to chat with you, or feel free to give us a call. Our client experience and advisors will be back online from 8:30 tomorrow morning. Thank you.
Thank you.